Has Bitcoin truly hit a wall it cannot climb, or is this just another fleeting bump on its ever-dramatic journey? That question has been rattling around countless social media feeds, investor circles, and casual coffee shop chats everywhere. If you are looking at the latest market data, you might see that the drama surrounding Bitcoin has reached new heights, especially after it slipped by roughly 0.9% within the last 24 hours. That might not sound like much to some people, certainly not the kind of meltdown you would see in a tabloid headline, but it is enough to get voices buzzing. The entire crypto market seems unlike its usual self these days. Why? Because whenever Bitcoin sneezes, it appears that altcoins come down with the flu. And this time, they are feeling the fever more than ever, with certain tokens plunging by anywhere from 8% to 15% in a matter of hours. Is something bigger at play here, or is it merely the pause before the next mighty upward rally? Today, we will dissect every nook and cranny of this enthralling story. We will uncover how traditional economic data has intertwined itself with digital currency valuations, and we will explore the behind-the-scenes reasons why altcoins have experienced a heavier blow than the mighty Bitcoin. Stay tuned to find out exactly how these pieces fit together and why this is not just another passing fad. For those of you just tuning in, here is the big picture. Once upon a time, the cryptocurrency sphere was a kind of renegade domain, mostly populated by tech enthusiasts, visionaries, and a dash of opportunists. Back then, nobody really sat around waiting for official data releases like the Consumer Price Index or the Purchasing Managers Index. The waves in crypto were mostly generated by cutting-edge projects, new exchange listings, or spectacular exploits that either enriched or devastated participants. It was an underground universe powered by inventive minds who believed in a future that transcended traditional finance. Now, fast forward to this moment, and you will see a drastically redefined cryptocurrency terrain. Institutions have arrived, corporate whales are in the water, and the entire digital asset marketplace is no longer an isolated island. Instead, it is meshing with broader global economics. If unemployment numbers hint that the workforce is strong or fragile, or if inflation measures tick up or down, you had better believe that Bitcoin notices. Even the faintest whisper from someone like Jerome Powell, who is scheduled to speak this afternoon, can send tremors through the digital money world. The real showstopper is how conventional financial yardsticks, once so alien to the crypto domain, now sway the fortunes of Bitcoin and its counterparts. In the days of yore, the idea that a job openings report or the release of an index measuring manufacturing stability would matter to a decentralized digital coin seemed absurd. Yet here we are, with traders bitten by the official data bug, eagerly tuning in for fresh signals. Will interest rates hold, rise, or decline? How might this tilt the downward or upward trajectory of major coins? As if that were not enough, the correlation between the cryptocurrency roller coaster and traditional stock markets is forging an even more complex tapestry. Because of institutional involvement, the willingness of big funds to take risks, or dial them down, translates across multiple asset types simultaneously. That is to say, if you see a shift in the prices of major publicly traded corporations, there is a decent chance that Bitcoin prices might track in the same direction, at least for a short while. Of course, not everyone is thrilled about that correlation, with some enthusiasts longing for the old days of independence. But such is the modern crypto reality. Unpredictability now hinges on economic signposts that older generations have used for decades. Speaking of unpredictability, let us look at some real numbers from the battlefield. Converted expertly into words, of course. Bitcoin is now at around $106,500, a subtle yet potent tumble from the $109,000 it nearly touched yesterday. That one little slip might raise eyebrows, but it is the altcoin sphere that is showing the real fireworks. Coins like TKX, ARB, SPX 6900, and SEI have been slammed with reversals ranging from 8% to 15%. The question every investor is posing is, why the bigger heartbreak for altcoins than for the reigning champion? The reason is not as simple as shouting, "Bitcoin is king." There is a complicated interplay of liquidity, investor sentiment, and the well-known phenomenon of Bitcoin dominance, which has quietly been creeping northward. When Bitcoin's share of the total market capitalization rises, it often heralds storms in altcoin territory. This begs the question, are we entering a phase where the market recovers under the shade of Bitcoin, leaving altcoins struggling to find new momentum? Before we dive deeper into these labyrinthine details, why not take a moment to show your support? If you are enjoying the insights so far, feel free to tap that like button. No pressure, just a friendly reminder that your appreciation helps keep these in-depth explorations going. Now, let us delve further into what is happening behind the scenes. Analysts are saying that the correlation between digital assets and equities has never been more pronounced, largely thanks to the influx of institutional players who treat crypto in much the same way they handle stocks. This is not entirely shocking. After all, if a global hedge fund holds positions in both technology companies and Bitcoin, a shift in the economic outlook might force them to rebalance their entire portfolio, inadvertently affecting cryptocurrency prices. That said, another vital piece of this puzzle is investor psychology. The public, spurred on by sensational headlines, can leap to conclusions faster than a sprinter out of the blocks. One discouraging piece of news, like a slip in the purchasing manager's index or a rumor that interest rates might climb by a fraction of a percentage, could spark a mini panic. On the flip side, a promising report about job growth or stable manufacturing can reignite buying frenzy, even if only momentarily. The real trick is figuring out which piece of data is a genuine signal and which is mere noise in this echo chamber of speculation. Of course, no conversation about national economic data would be complete without a mention of Jerome Powell. Scheduled to speak later today, the chair of the Federal Reserve has a knack for influencing global markets with a few carefully chosen remarks. If the tone of his speech is dovish, perhaps hinting that the economy can endure current interest rate levels, we might see a short-term surge in appetite for risk assets, which includes cryptocurrencies. Conversely, a hawkish stance that implies further tightening could chill the crypto sphere, sending nervous holders scurrying to safer havens. Not long after that, we will see the release of job openings data, PMI, and the ISM Manufacturing Index, acronyms that might have seemed unrelated to Bitcoin in its early years, but now command traders' rapt attention. Each data point is akin to a puzzle piece that helps speculators form a clearer picture of where the economy is headed and how the Federal Reserve might react in the coming months. With so much riding on policy forecasts and macroeconomic signals, it is no wonder that many experts are urging caution. The price of Bitcoin was not always so sensitive to these announcements, but times change. The concept of corporate whales is particularly intriguing here. These are institutions that have allocated vast sums into Bitcoin, effectively linking their digital asset strategy with broader business operations. Imagine a large manufacturing company with a treasury division that decided to hold a portion of its assets in Bitcoin. If economic data suggests upcoming hardships, that firm might opt to liquidate some of its crypto holdings for the sake of corporate security, inadvertently pressuring Bitcoin's price downward. On a grander scale, these large trades can ripple across the market. Meanwhile, altcoins, being individually smaller in market size, suffer from sharper swings because they attract less stable capital. A single substantial sell-off in, say, a mid-cap coin can produce double-digit percentage plunges, fueling a cycle of fear-based selling among smaller holders. Yet, not all is gloom and doom in today's showcase of price movements. Bitcoin Cash has defied the downward draft to climb about 6%, leading many to ask, what is fueling that unexpected rally? Some market watchers speculate that accumulation by niche investor groups or upcoming upgrades to its protocol might be feeding this optimism. It is worth noting that contrarian moves like this occasional Bitcoin Cash surge also highlight the market's unpredictability, giving hope that even in a sea of red, an unanticipated lifeboat might appear for savvy speculators. As we peel back the layers of the current spectacle, never forget that every piece of data, every pivot in sentiment, can become an educational moment. If you have found value in these insights or want to stay on top of future narratives, consider subscribing or following us for more daily deep dives. Remember, knowledge in this sphere is often measured not just by the size of your holdings, but by the depth of your understanding. This collision of traditional finance and digital tokens has also heightened the complexity of altcoin dynamics. Take, for instance, tokens like TKX, ARB, SPX 6900, and SEI. They have experienced stumbling blocks in the range of 8% to 15% over the last day, yet each has its own story. TKX, for example, might be wrestling with investor confidence issues rooted in concerns about regulation or a perceived lack of tangible real-world utility. ARB could be facing questions about the sustainability of its on-chain governance or doubts about its total addressable market. SPX 6900 might be grappling with a wave of profit-taking after a recent run, while SEI might be entangled in behind-the-scenes operational challenges or developer disputes. The particulars can vary, but what they have in common is vulnerability to macro headwinds. When high-level economic signals suggest that liquidity might shrink or that interest rates could climb, speculative capital is often the first to retreat, leaving altcoins high and dry at least for a time. That is not to say altcoins will remain forever in Bitcoin's shadow. As the world grows more comfortable with cryptocurrency in general, institutional investors may further diversify their portfolios to include not just Bitcoin, but also these smaller yet potentially higher upside tokens. Already, we have examples of decentralized finance projects capturing mainstream attention. The real takeaway is that altcoins can see accelerated price appreciation once conditions turn favorably bullish, but they also endure steeper declines whenever uncertainty or risk aversion creeps in. Some might call altcoins the perpetual roller coaster of the crypto market. With all eyes on upcoming economic signals, we find ourselves in a holding pattern, waiting to see which direction the cosmic winds of finance will blow next. If the Federal Reserve indicates a loosening stance, altcoin believers might interpret that as a green light to jump back in. On the other hand, if metrics point to inflationary pressures or a looming recession, caution could remain the name of the game. In dissecting today's retracement, though, one can spot the valuable lesson that volatility is the crypto market's twin sibling. Indeed, from day one, no one ever promised a smooth ride. This is part of the enthralling allure that draws risk-takers to Bitcoin and the extended altcoin family. After all, it is a market that never sleeps, providing endless opportunities for both triumph and miscalculation. Some traders accentuate the highs, championing the transformative power of blockchain technology to reshape finance. Others caution newcomers to tread lightly, reminding us of cautionary chapters in crypto's history, from devastating exchange hacks to sensational rug pulls. But what is indisputable is that crypto is here to stay, evolving and reorienting in response to external stimuli like serious economic data. This interplay makes for a dramatic narrative, a never-ending dance that merges cutting-edge tech with the centuries-old discipline of market speculation. Meanwhile, speculation surrounding the policies of central banks across the globe has only accelerated. Consider how many nations have reeled under inflationary pressures in the last 2 years. Central bankers from Europe to Asia can, with a single statement, nudge investors to rethink their stances on Bitcoin and altcoins. Crafting multinational strategies becomes crucial for large-scale traders who juggle multiple currencies, from the euro to the yen to the dollar. Then, add to that the complexities of trade wars, supply chain disruptions, and regulatory crackdowns on certain crypto activities. The swirling cocktail of global events is enough to overwhelm even seasoned analysts, let alone novices who jumped into crypto on a wave of hype. Nevertheless, these same complexities make the digital asset arena an enthralling battleground, ripe with both extraordinary gains and sudden pitfalls. The competence of each investor hinges on how skillfully they digest information and interpret signals from a host of sources, including central bank remarks and government data releases. All of this leads back to the immediate question: what is next for Bitcoin, having paused at the brink of $109,000 only to slip toward $106,500? And for the broader altcoin market now fielding significant double-digit drops in certain segments? Some argue that this is a prime moment to accumulate, anticipating that the Federal Reserve will moderate its policy stance, enabling a surge in risk assets. Others remain cautious, pointing out that we may be on the verge of a longer economic downturn, and that digital assets could very well retest lower support levels in a more turbulent scenario. The prudent approach, as always, is to conduct thorough personal research, maintain a balanced portfolio, and never invest more than you can handle losing. After all, the unspoken truth of every bull market is that it is often followed by an equally vigorous sentiment correction. As we close this chapter in the cryptocurrency saga, it is clear that the interplay between institutional involvement, data releases, and the fluid nature of the altcoin space creates a wealth of possibilities for watchers everywhere. Will the next big data release catapult Bitcoin beyond that elusive $109,000 threshold, igniting a fresh wave of optimism, or will it underscore a more extended period of market doldrums? Only time and the guiding hand of policymakers and corporate whales will tell. In the interim, remain vigilant. Absorb the daily flurry of news headlines with a measured dose of skepticism and curiosity. Reflect on how this nexus of technology and macroeconomics is reshaping the very foundations of finance. One thing is for certain, each move upward or downward gives us one more piece of this ever-evolving puzzle, forging the path toward mainstream acceptance. And when in doubt, remember the golden rule of investing. Manage your risk, stay informed, and never let the thrill of quick gains blind you to the fundamentals. The crypto stage is nothing if not a gripping drama, so hold on to your seats, because the next act may be just around the corner.